Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Ian Vanderhorn, US-based macro strategist, and I'm joined here today by our global market specialists, Paul Robson and Oriane Parmentier. Paul, let's start with you given we just had the Bank of England decision. What were the key takeaways from that meeting?
Well, I think the key takeaway was that we received a dovish hold. I think the keeping interest rates on hold wasn't a surprise to us, wasn't a surprise to markets. But what did provide a surprise was the vote count in favour of keeping rates on hold at 375. The market was expecting a 7-2 vote with just two dissenters wanting to cut rates, two well-defined doves, Taylor and Dingra, but they were actually joined by Ramsden and Breeden. So it was much closer than the market expected, and it was a dovish surprise that saw about 7 basis points taken out of the curve in terms of lowering expectations for interest rates going forward. The main swing voter on the MPC remains Governor Bailey, and he seemed a little bit more confident that inflation was going to come down and a little bit more confident it was going to come down a little bit more quickly. There's still uncertainty about how quickly inflation comes down and to what extent that starts influencing wage settlements, which is going to be crucial. We still think on balance the next and final cut from the Bank of England will come at the April meeting, meaning we get a terminal rate, an endpoint of the easing cycle at 3.5%. Conceivably that might come in March, but we wonder whether there is going to be enough supporting data to justify Bailey tipping his vote from hold to a cut. And equally, markets that have moved to price in 50 basis points of cuts for the rest of the year, including that cut that either comes in April or March. Maybe we do get a second, but we would want to see a much sharper deterioration in the labour market and much more confidence in that inflation is coming down sustainably to target. So it was, in the end, a dovish hold that surprised markets.
Absolutely. So a bit of a dovish surprise in the vote count, as you said, and we're looking ahead to April as the most likely opportunity for another cut. So as we leave January behind, I can't believe we're already in February, but is there anything else from January that you'll be taking into the rest of the first quarter?
Yeah, I think to a large part it was just how gilts enjoyed their time out of the limelight for most of the first month of the year. Like you say, it seems to have gone super quickly. Hopefully spring is a little bit closer. We'll start getting longer days from here. The focus for global bond markets really in January, there was a lot of focus on US policy, Fed leadership, Trump and geopolitics. But in the UK, we had quite a lot of supply and that got taken down well. It does tend to get taken down well at the beginning of the year. I think investors know it's coming and they make sure that they have fresh powder or funds. So that's not necessarily a big surprise. There was a focus on carry. If we get low vol markets, then people will look for carry opportunities. And I think that the gilt market was one of those areas. January was also an important month in the UK in terms of coupon payments and redemptions, especially or solely low coupon redemptions. And the focus was very much on how that would be reinvested, and so the theme of low coupon, high coupon, retail investor appetite to reinvest was definitely a focus. I mean, the dynamics there have changed a little bit about whether the same appetite remains. But as we get into February, I think the key takeaway is that those themes of redemption, coupon payments, and also some hedging strategies flows as well. It means that we get a cleaner story come February, back to focusing solely on supply, I think, on the heroic assumption, I think, that the politics in the UK remains relatively stable.
Makes sense. So get through a little bit of the start of year chop, as you described. The other thing I want to ask you about is that it looks like UK assets in general were a little soft this week. And I know that was probably the case globally, but I'm just wondering, how are you thinking about that softness? And what should we be looking at there?
Yeah, that softness in UK assets, I think most roads lead to higher political risk premium. I'm not going to go into the reasons for that or heighten focus on leadership change here in the UK. It's been widely reported. People can seek out those reports and make up their own minds about it. For gilts, I just concentrate on historic correlations over the last couple of years, and the correlation's been pretty stable and relatively tight, that gilts don't like increased political uncertainty. Gilts underperform when those risks rise. As I say, there's been a number of episodes, and I think where the worry lies is more about whether there is a dilution of fiscal policy via a change of the fiscal rules. What we learned in 2025 was that investors put a lot of weight on those fiscal rules being unchanged, and if they're softened, of course you can continue to meet a new set of fiscal rules, but it means that borrowing shifts and issuance shifts, and at a time when there is a global glut of supply of sovereign bonds, and that ultimately matters. And maybe at some level, more spending, more borrowing, higher taxes, pressure on Bank of England to cut rates. So it feels very much, if we take the Bank of England and we take some of the political shifts, the UK gilt curve steepens, and that's exactly what's happened. I think that plays through a greater risk premium, and also through a greater inflation premium. The other point I would just highlight is, who has been the marginal buyer of gilts over the last couple of years? Now, bank treasuries have been happy to purchase the supply of bonds that the DMO is issuing, but also overseas investors. And they are more price sensitive, and they're more sensitive to some of these Pacific risks around the UK, and so that makes gilts vulnerable. It's not a huge surprise to us. I mean, we continue to hold to our 480 target for the second quarter. We thought that might come around some of these political risk events that were in the calendar. We continue to be a little bit more bearish than the consensus, but the events over the last couple of weeks, I think, just gives us confidence that that's the right way. So looking at the May local elections, the spring statement, and there's also a key by-election at the end of February that will be keenly watched, we think.
Absolutely. We're certainly seeing some of those themes here in the U.S., especially when it comes to term premium and some of the sensitivities from global investors that you mentioned as well. But before I dive into that, actually, let's switch over to you, Oriane, because the ECB just made a decision today as well. I know it was a little bit less exciting than the BOE. It seems like a very consensus and balanced decision. But what are your thoughts on that meeting, and maybe what are your thoughts around euro rates more broadly following that decision?
Yeah, sure. So the ECB kept its rates unchanged, as widely expected, as you were saying. Given there was a focus on the recent FX moves with the euro appreciating against the dollar, some attention was expected to be on the comments from Lagarde on potential implication, notably for inflation. But I think Lagarde's messaging was, extremely clear that risks around the baseline scenario were all pretty well balanced. She did note both upside and downside risks to inflation. The data dependency and meeting by meeting approach was reiterated quite clearly again here. And I think she really tried to push back against the temporary noise from, the more recent FX moves, really. She insisted that the dollar weakness was a trend initiated in March last year, and that the Euro-USD pair had been range-bound since the summer. So she kind of like pushed back against, market focus perhaps on the more recent FX moves, and also given that they were partly reversed as well. So while domestic market took perhaps this comment with a slightly hawkish tilt, our own expectation for, no change in rates for this year is, really intact. Market expectation accurately reflect that. So the way I would see it is Lagarde's comments were perhaps trying to reshift a bit the balance to neutral, with perhaps, a slight dovish bias from markets entering the market. So no change, in the view for the ECB for the rest of the year. We don't expect a change, either a cut or, a hike from the ECB here. We continue to target 3.20% in bonds as well, with the elevated supply both in Europe and beyond expected to weigh on attract yield. And we also continue to have a steepening bias for European curves in general. And in that respect, I think it's worth noting that Belgium came this week with a new 30-year bonds. But we also expect syndication out of Spain and potentially France as well in coming weeks. There is also a potential syndicated tap from Germany on the 30-year sector for Q1. So a lot of 30-year supply expected in the near term, in a context where we expect change in structural demand for the long end in Europe. So continue to hold to our 10-30 steepness in that sense. Right. So let's turn to the US. We didn't have a Fed decision this week, but there was ample talk about President Trump's nominee to be the next Fed chair. So what should we be thinking about, with respect to Kevin Warsh?
Kevin Warsh, in my view, was a pretty interesting pick from President Trump, particularly because he's definitely, at least historically, been one of the more hawkish candidates among the finalists. Kevin Warsh was a Fed governor before. He was a governor through the great financial crisis. And he was really one of the more hawkish voices, I'd say, through the recovery thereafter, specifically with respect to the Fed's use of its balance sheet. He was in support of the initial round of QE in 2008, but less so when the Fed began doing other rounds of QE in 2010 and 2012 thereafter. So the big thing with Kevin Warsh is that he's been very outspoken, I'd say, about the Fed's use of its balance sheet, as well as what he describes as mission creep. He thinks the institution is finding its way sort of into the center of markets, which we all know to be true. He thinks the Fed should really instead be on the back pages. So just generally, I'd say a very big critic of the Fed's current strategies, and really its strategies of the post financial crisis era. He really does feel that the Fed's balance sheet is, particularly its use in 2020, which we all know to have been essential. But he thinks that is behind a lot of the last 5 years or so of inflation. So if we're just thinking about markets, I do think it's probably right for the primary focus for markets to be on Warsh's view of the balance sheet and how he's going to change that. A lot of the chatter is already around his eventual attempt to shrink the Fed's SOMA holdings. So shrink the Fed's balance sheet as a primary goal, and that would probably involve selling treasuries really, or at least letting them roll off as they mature. And the risk there is really that if you shrink the Fed's balance sheet, you could see increased real yields. It's also potentially a swap spread tightener as treasuries cheapen to swaps just based on the increased supply that markets would have to take down. So that's the risk. But I think the interesting spin here is that if you shrink the balance sheet and you have these tighter financial conditions, be it, in theory, this could also allow you to lower the policy rate. And that's really Kevin Warsh's argument. We think that's probably the playbook that Warsh will try to run. So in the run-up to actually getting this nomination, we kind of wonder what the discussions with President Trump looked like. And we think it probably looked like Warsh telling President Trump, hey, I can lower policy rates, potentially a lot. But the flip side to that is it doesn't necessarily mean looser financial conditions if you're also running down the balance sheet. So in the eyes of Warsh, cutting rates another 75 basis points to 3% level, that's probably not a big deal in his eyes because he might not even see that as having too big of an impact on inflation. So let's just assume that that is his goal. For, I think, the near term, we think that he won't hesitate at all to try to move the committee to cut rates pretty much as soon as he's in the seat in June. Our broader Fed call is still that we're expecting cuts to begin in June with one big, I should say, 50 basis point cut followed by another smaller 25 basis point cut rather for 75 basis points of total easing. So we think that playbook is still in place. For that argument, though, he's not going to be talking about balance sheet initially. He's probably going to be leaning on the argument that we've heard from the administration, Scott Bessent, President Trump, and others, being that the U.S. is in the midst of this productivity boom, this great expansion that's coming from AI. And if we have these expected productivity gains, it's really, a dampener on inflation broadly. So that's what he's going to try to pitch to the committee. He's going to say, look, we can cut rates now because the impact to inflation is going to be negligible. But, the balance sheet side of the equation, I think that's a lot harder to do smoothly, let's say, just because it means that the public is going to need to own more of these treasuries if the Fed runs down their holdings. And that's where we think that the sequencing of Warsh's moves are going to be really important. One of the things we're considering that they might approach again is taking another pass at bank deregulation. We already had bank deregulation sort of implemented at the end of last year as some of the SLR reform was done. We think they're going to try to take it a step further. He might try to do things like exclude treasuries from leverage ratios altogether. The goal of any of this reform, though, would just be for banks to potentially own more treasuries as the Fed transitions to owning less. So, it's really, I think, a lot of potential moving parts here. The timeline is certainly not in the near term. We definitely need to first see Kevin Warsh get approved by the Senate. There's some hang up there currently. I won't get into that. But these sort of trends are definitely over the longer term when it comes to the balance sheet. The near-term trends, though, once he's in office, we think that Fed easing could be implemented under him as the leader. And then I guess just with respect to our views, we're very comfortable with our sort of long-held view at this point for a steeper Treasury curve. We've been calling for significant bear steepening for September. And we think, that's still in play with Warsh and under a Warsh-led Fed. specifically will have, him cutting rates in the front end, and then the long end of the curve could potentially see higher yields just as the Fed moves towards this balance sheet transition. So yeah, that's pretty much how we see it in our eyes here. Most of the roads in markets lead to a bear steeper Treasury curve. So let's leave it here for today. If you enjoyed today's episode, please remember to like and subscribe, and thank you for listening.